NVIDIA CEO Jensen Huang dropped a bombshell at the Financial Times Future of AI Summit, declaring that China is going to win the AI race. Coming from the leader of the company dominating the global AI chip market, this statement is nothing short of shocking. Why would Huang make such a bold claim? He pointed out that U.S. government export controls on China could undermine America's technology ecosystem in the long run. Specifically, he warned that China's massive developer base needs to build on NVIDIA systems, but current U.S. policies are completely blocking the Chinese market, thereby weakening the growth foundation of American tech companies. This also serves as a rebuttal to President Trump's recent statement that NVIDIA GPUs can only be used by American companies. From Huang's perspective, export control uncertainty is directly hitting his business. In fact, NVIDIA stock fell 1.8% on November 5. But Huang's warning isn't just about corporate profits. China's recent moves confirm this. The Chinese Ministry of Commerce announced it will add at least 5 staff members to manage rare earth exports starting in 2026, the largest expansion since 2022. What does it mean that they're taking this step despite agreeing to a trade truce at the US-China summit? According to expert analysis, China is pursuing a strategy of maintaining exports during the short-term truce while strengthening long-term control systems. When they implemented 7 rare earth export controls last April, they reportedly doubled related personnel on a temporary basis. This expansion into permanent positions shows an even stronger commitment to control. It's not just rare earths. China's influence over automotive semiconductor supply chains has proven larger than expected. Tensions between China and the Netherlands are escalating over Nexperia, a Dutch automotive semiconductor producer acquired by Chinese smartphone assembler Wingtech in 2019. Even though China lifted export controls on Nexperia on November 1, the Netherlands is maintaining its seizure of management rights. With Europe's economy closely tied to automotive production, concerns are spreading that the economic impact could be larger than expected. Despite these supply chain pressures, U.S. markets rebounded on November 5. The S&P 500 rose 0.4%, Nasdaq gained 0.7%, and the Dow climbed 0.5%. Given the relatively large drop the previous day, this represented bargain hunting, but it wasn't just technical bounce back. There were several structural reasons. The biggest factor was the Supreme Court oral arguments. When justices began discussing the legality of tariffs imposed by the Trump administration under the International Emergency Economic Powers Act, IEEPA, 3 conservative-leaning justices unexpectedly criticized the administration. Chief Justice John Roberts asked whether the president could exercise tariff authority when it's clearly Congress's core power, and isn't even specified in the IEEPA statute. Justice Neil Gorsuch used the metaphor of a one-way ratchet, a mechanical device that transmits power in one direction, but spins freely in the other, to point out abuse of authority, noting that, once delegated, the power cannot be recovered. Justice Amy Coney Barrett also posed intriguing questions. She questioned whether extending tariffs to EU countries beyond China constituted abuse of emergency declarations, while mentioning the administrative burden and economic shock of refunding the $900 billion already collected. Local media analyzed this as emphasizing the real damage from power abuse. Why does this matter to markets? If tariffs are ruled illegal, inflation pressures would ease and expectations would rise that the Fed could focus on defending the labor market. Concerns about corporate margin pressure would also diminish. However, experts analyze that refunds are realistically unlikely. Still, just reducing legal uncertainty was positive for investors. Earnings season results also lifted markets, with 80% of S&P 500 companies reporting Q3 results. The EPS growth consensus was revised upward by 4.4 percentage points from 7.4% at the end of September to 11.8%. More importantly, Q4 guidance provided by companies was revised up 0.2%. This is the opposite of the typical pattern where guidance drops during earnings season. AMD's post-close strong results helped dilute AI bubble concerns. The Philadelphia Semiconductor Index surged 3.02%, and AMD stock rose 2.31%. But here's what's interesting: NVIDIA fell 1.8% and Microsoft dropped 1.4%. This signals a shift in AI investment structure from AI infrastructure NVIDIA, Microsoft to AI applications AMD, Qualcomm. Qualcomm reported after the close with both revenue and EPS beating expectations. Notably, non-Apple revenue grew 18% year-over-year and automotive chip revenue increased 17%. This indicates revenue diversification is progressing. Yet the stock fell 2.6% after hours, likely because expectations were already heavily priced in. Electric vehicle stocks are also worth watching. Rivian jumped 23.36% as Q3 results exceeded expectations, and Alphabet rose 2.44%, reportedly influenced by Apple's integration of Google's Gemini into Siri. Economic indicators also came in better than expected. ADP's October private employment rose 42,000, well above Wall Street's 25,000 estimate. Considering the prior month's minus 32,000, this was a clear rebound, though it's worth noting it's half the first half average of 84,000. The ISM Services PMI also beat expectations at 52.4 versus the 50.5 forecast. With the government shutdown now in its 36th day, official economic data isn't being released. That's why markets are reacting more sensitively to private indicators like ADP. David Russell, global strategist at TradeStation, said, "Retail and professional services show signs of slowing, but overall the labor market remains strong. This level of data makes it difficult to justify rate cuts." Looking deeper into employment data reveals interesting patterns. While ADP employment rebounded, retail, transportation, utilities sectors increased while professional, business and information sectors decreased. These are jobs exposed to the risk of AI technology displacing workers. McDonald's CEO also mentioned in earnings that low-income customers are struggling with rising housing, food, and childcare costs and significantly reducing their fast food visit frequency. This shows a dual structure of quantitative recovery but qualitative deterioration. Bond market movements are also intriguing. The 10-year Treasury yield rose 7 basis points to close at 4.159%, and the 2 to 10-year spread widened to 52.8 BP, the largest steepening in 2 weeks. This means that short-term rates rose as perceptions spread that the U.S. economy is still strong, following strong employment data, while long-term rates rose even more as Treasury buyback plans suggested increased long-term issuance. Both signals economic recovery expectations and rising fiscal burden appeared simultaneously. Expert opinions are somewhat divided. Phil Blancato, chief market strategist at Osaic, took a cautious stance. "We won't know the effectiveness of tariffs, their resolution process, and impact on prices until Q1 next year." Seema Shah, global strategist at Principal Asset Management, was more optimistic. "As long as these companies continue to deliver results, the market will continue to be okay." Robert Edwards of Edwards Asset Management said, "For investors holding cash, the recent market correction looks like a good buying opportunity." The ISM Services price component hitting its highest level since 2022 is also notable. This indicates cost increases from tariffs are appearing in some industries, though overall tariff-driven inflation risks are trending downward. After the US-China summit, risks of increased tariffs on China were resolved, and existing fentanyl tariffs were reduced. The schedule ahead is also worth tracking. On November 6, the Bank of England's rate decision and US weekly initial jobless claims are scheduled. And on the 7th, September wholesale inventory data is due. However, these may not be released due to the government shutdown. Fed officials including New York Fed President John Williams are also scheduled to speak on the 7th. To summarize, Huang's warning isn't just about corporate interests, it reveals the complex reality of the US-China tech power competition. China is strengthening its grip through rare earth and automotive semiconductor supply chains, while the US tries to maintain short-term advantage through export controls. But this could weaken the growth foundation long-term. US markets rebounded on strong earnings and tariff relief hopes, but AI investment structure is shifting from infrastructure to applications, and the employment structure shows duality of quantitative recovery amid qualitative deterioration. With sector differentiation intensifying, this is a time to carefully examine earnings and structural changes rather than blindly following trends. Keep an eye on the dual signals sent by bond market steepening too. So right now, it's fair to say we're in a positive but complex moment. Whether Huang's warning is corporate-level dissatisfaction or a genuine forecast of tech hegemony's direction remains to be seen.